Welcome to another edition of Inside the Economy. I'm Larry House. Thanks for joining me. I want to talk about affordability this time. Affordability is most likely referred to in the housing market. Some of the fundamentals on the outlook for 2026 in the various stock markets, and how the global supply system, it has changed, and who competes with who. Quick look at the numbers. Federal government was down. There's a little gaps in some of the economic data. Everything that's been reported so far, CPI down, core is down, PCE core is down, initial jobless claims are down. Well, okay. They're destined to be down. They may correct a little bit as the data gets a little more complete. Interest rates are all kind of down. Mortgages you were hoping would get in the fives. That may not happen. And I don't think it's very likely we're going to get an interest rate reduction here in January. In fact, I give you about a 15% chance of that. So the mortgages are going to stay in the low sixes. The interest rate has a big impact on that. But the industry is also very interested in the spread in their own business. And they need to make 6 at this point because the cost of money is 3.5. Anyway. Oil has been interesting. It's really not going anywhere. Big crisis with President Maduro changing residences. You'd think that'd have a big impact on the oil market. It didn't. More about that later. Okay. Affordability and what's going on in the housing market basically starts here with shelter costs. Shelter costs, the growth of shelter costs are down. It's down where they should be. Pretty much in line with inflation. It's not going to change a lot of things other than the growth and what's going on in the rental market has slowed significantly. But affordability, which is going to be a big political arena, costs $200 a foot to build a house, plus or minus. Depends on how much gold you have in there. The prices of these houses aren't going to come down. The affordability is up there high. It's not where it was a long time ago, but it's not going to drop that much either. This is a result of inflation in the system. You've heard this before. It's clearly a part of the $4 trillion we put into the system for COVID, right? Move of the time, very likely, but that money is not coming out of the system. The Federal Reserve has made that kind of clear. That's going to stay in the system. That's one of the reasons the S&P 500 has had 3 such positive years. Earnings have been okay, but there's a lot more money in the system, and it's not coming out. So everything is going to have to adjust up. Real home prices? Well, no, they're not going to adjust. It's that $200 a foot thing, availability. Multifamily is filling in the blanks. But it's a result of all the money. So on a positive side, and I track this kind of stuff, this is from the Federal Reserve Board. After a lot of the money was inserted in 2020, on the chart here, people started paying their debt down. In fact, the U.S. private sector debt, individuals, some corporations, it's the line there is trending down. There isn't a bubble being created here. There isn't a debt bubble. Debt you have to pay back bubble, as opposed to the U.S. debt, which is money in the system. The bubble is not forming. It might be a little blister, it might be a little bump, but the consumer is not full of debt. And corporate America, well, is sort of reacting like this, the S&P 500 and the rest of the markets, representative markets. They're kind of going sideways. They got the message. They got a little ahead of themselves, got a little ahead of earnings. But they certainly didn't correct right away because there's still the prospects of cheaper money in the first quarter next year. Cheaper money means the algorithms will buy. The whole buy side of the markets, the institutions, well, if money gets cheaper, they're going to buy more. That's one of the reasons that the outlook for 2026 is still pretty good. There's a lot of things going in that direction, barring some big incident. The other side of the coin is, how is corporate America doing? Well, this is productivity. It's excellent. This isn't AI. AI has had some influence on medicine, a lot of legal profession, architecture, all kinds of things. AI has had a big impact, but productivity is up. Workers that have jobs, especially on the service side, are doing better. So the outlook for earnings is good too. It's just another part of a fairly good outlook for 26. Speaking of the buy side of the markets, this is kind of where they are. There's always a high and a low. This is where they think the S&P 500 is going to be in 2026. And as uncomfortable as it might be, they're all universally positive. About 50 of them out there that I've read, and they're all positive. There isn't any drags or headwinds on the S&P 500, and the fact that we might have lower interest rates is not a huge factor. In fact, it might be more of a don't take money too low because it will just have to crank it up again. This is where we'll probably see. Now, recognizing what's going on, well, what has occurred in Venezuela, you'd think that a very important oil-producing country like that having a change of regimes would have a big impact on the price of oil. It is not. Changed very little. All those reserves, which are being underutilized, and this is basically the number of wells being drilled, almost nothing, they are parsing out that as we speak. I've mentioned before that the, let's say, quality of the oil that Venezuela pumps out, it's pretty nasty. But there's about 6 refineries along the Gulf Coast, northern Florida, Louisiana, a little bit of Texas, that are set up specifically to refine that stuff, mostly into diesel fuel. Well, great. There's a market for that. Guarantee you Chevron is definitely going to want to get in the tanker business, probably as we speak, to get down there and get what they can and bring it back up and put their refineries back to work. Understandable. Shell, I know, is waiting in line because 20 years ago, just like Chevron 20 years ago, before the Venezuelans nationalized all their stuff, Shell is getting in line to get back in the old gas well business. And there's a big one down there, several big ones. Anyway, oil has had a big impact. I don't know about the rest of the politics of that decision, but I can't imagine who's going to want to pay for the money to bring that whole system up into the 20th century. It's not unlike the oil system in Iran and other places in the world. It's just literally falling apart. Anyway, finally, a couple of questions on, well, one started with, well, the Trump tariffs have been a failure vis-a-vis China because China is still exporting a lot of things. And this is quite right. The tariffs were not a failure as far as the U.S. is concerned. If you want to restore U.S. manufacturing, you got to get rid of the low-income provider so that market will adjust. Well, that's actually been fairly successful. What the United States is importing from China anymore, as we know, and it's not new information, is down, and it's probably not going to return. The rest of the world, EU, Asia, Africa, are importing a lot of stuff from China. It's still attractive to them, except for the EU, which is already making noises about, well, we got this very costly, cheap producer, great for the consumer, bad for industry, especially Germany. They're going to have to do something about the low-end producer. The BYD cars, the Chinese electric car, are pretty popular in Europe because they're cheap. Doesn't speak well for the rest of the European auto industry. So they'll probably have to make some amends. And the rest of the low-end manufacturing part of the world, Africa, Eurasia, Mexico, that kind of stuff, they're still going to have to buy from China, but the ultimate customer is still the U.S. Okay, well, the outlook for 2026, since this is the time of the year that we talk about this stuff, is pretty positive. We've had 3 positive years. We'll probably have another one. Barring an incident, things are looking pretty good today. Well, thanks for joining me. Send questions along to info@shjwealthadvisors.com, and I'm happy to deal with them. And I'll see you next time